Welcome back to this channel. This is Unfiltered Forex with me, Clement, and today we'll be looking at leading and lagging economic indicators and the ones that are most relevant to look at when you're day trading. So, first, we start with the leading economic indicators. Leading, the stock market is a leading indicator of the economy in that it shows what's happening in the economy 3 to 6 months from now. If the stock market starts crashing now, that of course means this crash is going to be reflected in economic activity in the next 3 to 6 months. Yeah. And if the stock market starts rising after a big decline, that of course means that increase in economic activity will be reflected. That increase in the stock market prices will be reflected when in 3 to 6 months time. Yeah, so when we talk about the stock market, there are stock market indices that are monitored in this case, and those are the Nasdaq, the S&P 500, and the Dow Jones Industrial Average. The difference between these three is the S&P 500 or the SPX is comprising of top 500 companies in the US. The Nasdaq is comprising of top companies in the US in the tech industry. The Nasdaq is mostly a tech index comprising of tech stocks. Yeah. The Dow Jones Industrial Average comprises the top 30 US companies, not in terms of market cap, but rather in terms of reputation, their history. Yeah, top 30 quality companies, blue chip companies, some they're called that. So this means, of course, there are companies in the Nasdaq that are not in the Dow Jones Industrial Average, yet their market cap is as heavy as, or even heavier than, some companies in the US 30. But let's not get into that for now. Just hope you got the point. These three main indices, especially the S&P 500, since it's the aggregate of the two, are usually leading indicators of the economy. The second one, retail sales volume. Retail sales volume is the volume of sales that have been made by retailers over the past month. Yeah, this data is released every end of the month. No, not every end of the month. I think every second week. I think second week of the month by the census. Is this the Census Bureau? Let me check that. Yeah, the monthly retail sales are released by the Census Bureau. Yeah, as you can see here, the Census Bureau, they release data on the retail sales, business inventories. We're going to look at all this in a minute. Okay, next, building permits and housing starts. These numbers, building permits, of course, and the number of houses being construction works beginning, they show that the consumer or the economy in general, people have money, and therefore if there's more building permits, if there's more houses being started, that of course means the economy is doing good, because these are projects that require big money, and if there are many projects that require big money being started on the economy, housing starts, that of course means the economy is doing good. Yeah, so this is a leading economic indicator showing that things are good for now and they will stay good for a while. Another one, level of manufacturing activity. Okay, level of manufacturing activity is probably among the most leading indicators, as you can see here. The ones I have highlighted in green, these are probably the most leading, the most leading economic indicators are these ones. So level of manufacturing activity, the PMIs, this is Purchasing Managers Index. There's two main companies that release the PMIs that are commonly used. First, there's S&P Global. You know of S&P Global, the website We visit that quite a lot in this channel. S&P Global, they release their PMI, Purchasing Managers Index, for various economies all over the world. And then there's the ISM. The ISM is the Institute for Supply Managers, and they release their PMIs for the US economy every first and third business day of the month. Yeah, that's when the manufacturing and the non-manufacturing PMIs come out respectively. There's also durable goods orders. Durable goods orders, this is another important data piece, also released by the Census Bureau. Yeah, durable goods orders showing the orders that have been delivered to companies for durable goods. Durable goods are big purchases, like goods that are built to last, like cars. Cars fall in the category of durable goods orders. Big electronics, big factory equipment, those are among the durable goods orders. And therefore, high mhm, if these high cost equipment are being ordered by a majority of the consumers, if the orders are a lot, that of course means the economy is going to do good now and in the future probably. Factory orders, yeah, this is the same thing with the durable goods orders. This is the number of orders being taken to the factories, reflecting the strength of consumer demand, which in turn is supposed to reflect the strength of the economy. Then there's regional manufacturing surveys. These are not as common as these ones, and as you can see, this I have not highlighted them in any color because yeah, these are the most leading ones. Empire State Manufacturing Survey. This is of course released by the New York Fed. Philly Fed Manufacturing Index. This is released by the Philadelphia Fed. Federal Reserve of Philadelphia. That branch, they release the manufacturing index for that region, the Philadelphia state. Is it there a state? I don't know. Empire State Manufacturing Index for New York. Yeah. And then inventory levels. This is another leading indicator of the economy, because if you have, okay, let's put yourself in the shoes of a business owner. If you're seeing consumer demand will weaken in the future, or probably in the next month or in the next 2 months, of course you would want to cut your inventory levels, because you're already seeing that the volume of sales, retail sales volume, will be low in that time. So your inventories will be cut short to accommodate that change in consumer spending you're expecting in the future. Yeah, that's why inventory levels falls under the category of leading economic indicators. Very useful. And then there's the yield curves. Center back. Yield curves, yeah. Yield curves fall among the most leading indicators because, okay, I can't say it's efficient. It's too leading. Like the yield curve might invert today, and then a year or two from today, that's when we'll start seeing the economy actually crashing. Because yeah, the yield curve inversion is taken to mean that there is bigger short-term risk in the economy than long-term risk, which is very okay. Let's look at the yield curve. Here we are. This is the yield curve. I'll leave the link in the description so you can go check it out for yourself. So this website, ustreasureyieldcurve.com, it shows the yield curve of the US treasuries. And as you can see here, this is the percentage yield and this is the time frame. This is 1 month yield and this is the 30-year yield. 30-year bonds, 20-year bonds, 10-year bonds. This is a 1 month treasury notes, bills here. So in the short term, you can see the yield here is 5.6%, and in the long term, 10 years is as low as 4.37, I think. Yeah, somewhere there. Yeah, yeah, 4.34. That's the yield for the 10-year bond, while the yield for the 1 year is 5.37%. So when you're getting a higher return for a shorter period of time, of course, that means there is greater risk in the short term than in the long term, right? If you haven't understood that, you'll need to read that on your own, and you're going to get the point of why a yield curve inversion is usually bad news for the economy. Let's go back. Crude oil prices. Crude oil prices are leading indicators of the economy in that, yeah, when when crude oil prices rise, that of course means inflation is also going to rise. When crude oil prices fall, that of course also means inflation is going to cool. That's it for crude oil. But this is among the most lagging leading indicators, right? I believe you got that right. The most lagging leading indicators, meaning among the tall people, this is the shortest tall person. Yeah, including gold also. As you can see, I have highlighted it in red. This is crude oil and gold are leading indicators, but they are kind of lagging a bit. Among the tall people, these are the shortest tall people. Yeah, gold prices. Yeah, they gold does well when there's an economic crisis. So yeah, but it starts. There's something called delayed price adjustment. If you watch the video where I talked about what do you call it? The video where I talked about the pros and cons of fundamental analysis, I did mention about these things. Delayed price adjustment. It happens, and it's common with these two, crude oil and gold prices. Exchange rates. Okay, exchange rates. This is a leading economic indicator in that the, if the exchange rate is too weak or too strong, there might be an intervention from the central bank to either weaken or strengthen the home country's currency. Yeah. So the exchange rate is a leading indicator in that it kind of shows what the central bank is likely to do next. Yeah, so that was it for that one. Leading economic indicators, these are the main ones, and as you have heard, these ones are probably the least reliable, but this is the most leading, and these are the best. These are the best. Here, building permits, retail sales volume. I don't know why I didn't highlight that. Building permits and housing starts, PMIs, you have goods orders, factory orders. These are the most useful leading indicators in day trading because they tell you what to expect in the short term and in the long term also. But in the case of the yield curves, as you have heard me talk about, the yield curves is too leading. If the yield curve starts inverting today, it's likely that that bad news scenario will be reflected in the economy in a year or two. Yeah. And crude oil prices not reliable for the short term. But these ones, the PMIs, they do affect intraday price movements when they are released. And yeah, they are very useful when you're trading intraday activities. This for the stock market, these stock market indices, these are leading indicators for the economy, but they're not going to help you much when you are day trading. Yeah, these building permits, housing starts numbers, PMI, Europe goods orders, factory orders, these are the best to focus on because they also affect the stock market prices, right? So yeah, these are the ones you need to focus on: building permits, housing starts, PMIs, durable goods orders, and factory orders. These are the best leading indicators you will find. Moving on, let's go to the lagging indicators now. So this is where the more common terms come up. As you can see, PPI, CPI, CPI, PCE, earnings season, monetary policy, ADP. Yeah, these lagging indicators. Number one, employment data. Employment data is a lagging indicator because it takes a while to compile employment data, and you're seeing data of the previous month, and by the time this data is coming out, there might be some changes in the economy. And of course, if you've seen what's been happening recently, there has been revisions of previous releases. Therefore, not showing a clear picture of what the current job market is doing. So yeah, lagging indicators, employment data, definitely among them. Here, NFPs. The NFP report is of course a lagging indicator, but it's very volatile in the short term. I'll explain that in a bit. Of course, most of you, if you're a frequent visitor to this YouTube channel, you know why it's very volatile in spite of it being a lagging economic indicator. NFPs, ADP employment numbers. This one's in orange because it's not leading, it's not lagging. These numbers, they fluctuate a lot, and they don't necessarily represent, they don't necessarily really give the clear picture of what the employment market is doing. So this is just there. I don't know. Yeah, this is just there. And then jobless claims weekly data. This also falls up under the category of employment data. Jobless claims, weekly jobless claims, they are weekly, and therefore this is among the most leading indicators in the group of lagging indicators. This is the least lagging because this is updated every week, every week. You know that, released by the Department of Labor. You're going to check the website, you will see. Another one, GDP. This is the most lagging indicator. This is the most lagging indicator, economic indicator, because the GDP is released in three stages, right? There's two preliminary releases, and then there's the final reading, which is considered the actual reading. By the time we're getting to the final reading, we are already halfway into the next quarter, and this GDP data is coming final reading of the previous quarter. So yeah, this is a very lagging economic indicator. It's best you it's it's a lagging economic indicator, but still very volatile in the short term, sometimes very volatile. Inflation readings, yeah, these are also lagging indicators, inflation readings, because they don't give a clear picture of the inflation levels, especially because the US CPI, the Consumer Price Index, the BLS, they have changed the formula of how they calculate the CPI over time to show inflation being weaker than it actually is. So yeah, this is a lagging indicator, but very volatile in the short term because these are the main inflation readings also. PCE, this is another one. This is another inflation reading released by the Bureau of Economic Analysis, and it comes together with the Personal Income and Outlays report. You know that report, and that's where the PCE is. So these PCE, this is the most lagging of inflation readings, right? PCE is the most lagging inflation reading because if we're in August, right? This is August. The inflation reading for August will come out on the last week of September. That's how lagging this PCE is. You see, for the CPI, the inflation reading for the current month, August, will come out on the second week of September. So that one is less lagging. And the PPI, of course, this is in green because this is a leading indicator of inflation, but still a lagging indicator because it's in green because this is, of course, a leading indicator. PPI, this is the producer price index, the change in wholesale prices, producer price index. Yeah. So this change will first be reflected in the CPI and then later reflected in the PCE. So you can see the PCE is the most lagging inflation reading. Another one, corporate profits. This is the earnings season. This one is in orange because earnings season is a leading indicator and is also a lagging indicator because, as you remember here, I told you stock market indices are among the leading indicators. So the earnings season, for example, currently we are in Q3, right? We're in Q3, the second month of Q3, and companies are releasing their Q2 earnings. So yeah, this is lagging data because we are getting data for the previous quarter, not the current quarter, and therefore it's lagging in that sense. But company these corporate profits serve as a leading indicator of the economy, in that before an actual recession, we start with the earnings recession, right? You're going to first see corporate profits declining, and then that decline is what's going to be reflected in the economy later, and that's why the stock market is a leading indicator. Another one, interest rates. Interest rates in this case is the monetary policy stance of a country. This is very lagging because central banks, it's either they do too much too soon or too little too late. So yeah, interest rate, the monetary policy stance of an economy is usually lagging. So, and you can see, you remember, if you watch some videos or if you know how the forex market works, in day trading, the economic releases that affect monetary policy the most are the ones that are most volatile, and that's where these all other categories come in, except for the corporate profits in this case. Let me try and cancel that. Let's cancel that one for now. Yeah. So, these economic releases, employment data, NFPs, jobless claims, PCE, CPI, PPI, as lagging as they are, including GDP, as lagging as they are, these are the ones that affect market prices in the short term the most, because these are the releases that the central banks look at when they're determining monetary policy. That was it. There is no, I believe we've understood that. And yeah, I don't think there's anything else I have talked about. Yeah, and also these numbers, building permits, housing starts, PMI, durable goods orders, factory orders, these ones also affect the market in the short term a lot, because they are leading indicators of these releases. They are leading indicators of the CPIs, the PPIs, the PCEs. Yeah. So these ones, building permits, housing starts, PMIs, durable goods orders, factory orders, they are volatile in the short term, and yeah, together with these ones, all of these lagging economic indicators, they are very volatile in the short term, because that's what the central banks use to determine the monetary policy of a country. And the monetary policy stance of a country is what affects the exchange rate. That was it for this video. I believe I have talked about everything I wanted to say, and yeah, going to see you in the next video.